Good afternoon, all. Welcome to NEN webinar. My name is Ashwini, and on behalf of NEN and Vadhwani Foundations, I would like to invite you all for today's topic, raising your first round of venture capital funding. And here, I would like to introduce our expert speaker, Shashi Chimala. Shashi spearheads the National Entrepreneur Network, NEN. He is a serial entrepreneur and co-founded Covances, Indigo Technologies, Payport, and Cookies Coffee, among several others. As an angel investor and mentor, Shashi has advised and mentored several startups in the Silicon Valley and in India. Over the past 34 years, Shashi has served in a variety of management roles in companies across US and India. As an entrepreneur, Shashi has been featured in several national and international publications as well on CNBC and BBC news programs, etc. Before I hand over the floor to Mr. Shashi, there are few reminders for the audience. You will be on mute. You may ask questions by typing it in the panel provided. Over to you, Shashi.
Thank you, Ashwini. Hello, everybody. It's good to see so many of you taking time to attend this. I hope it'll be useful and I'm able to communicate a few tips and techniques. So today's topic is raising your first round of VC funding. And I have, been experienced in this. I've raised funding. So today, quickly, a couple of minutes about what Vadhwani Foundation is and why we are doing this. Vadhwani Foundation is a non-profit started by Mr. Ramesh Vadhwani, who is a Silicon Valley billionaire. And he is actually one of the first Indian entrepreneurs to pledge most of his money to Bill Gates, Warren Buffett pledge, meaning that he, has agreed to give away all the money that he has for charitable purposes. And we have many initiatives. I'm sure you can read more about on the website. Specifically, the National Entrepreneurship Network is all about helping entrepreneurs. We are a non-profit, helping entrepreneurs create jobs. Our job is to either help people who are already have an idea and wanting to start a company or have started a company or on the fence. So mainly we provide knowledge, we teach, we have workshops, we are in almost 250 colleges. We also offer mentoring if you need that. We can connect you with an expert, and we're also offering a lot of networking opportunities for you. Now let's get on to our topic today. So I have divided my presentation into three broad categories. One is, in order for you to help, raise the VC funding, you must know what happens inside a VC firm and how they work. So we're going to spend a few minutes on that. And then the second is a very important question. Do you need to raise VC funding? Should you raise VC funding or not raise VC funding? So to VC or not to VC? And then last, we'll jump into how to go about raising VC funding. So quickly, let's look at how does a VC firm work, So a big question and a frequent question that a lot of people ask me is, okay, VCs have, millions, if not hundreds of millions of dollars. Where do they get the money from? Basically, a VC organization, right, actually takes money from others and invests in companies such as yours, shows the returns, and makes money in the process. So a VC firm basically raises money from, let's say, insurance companies, endowments of educational institutions, pension funds, and a few high net worth individuals. Why? Why do they invest in a VC firm? Basically, what happens is, these entities have billions of dollars, and they need to put it to good use and show returns. Money cannot sit quiet. So they invest in stocks and bonds and many things, and they have a category called alternate investment, and venture funding falls under that. And typically 5 to 10% of a portfolio is invested towards VC money. So the bottom line is this: if you end up getting a VC fund, that money is not coming from the personal bank account of the VC that you're dealing with. It probably is representing some insurance company or some educational endowment or a pension or some NRI high net worth individual. So keep that in mind. Now, so how does a high net worth individual or an endowment put money into a VC fund? When 4 or 5 people go and start their own VC fund, obviously these persons, they have experience in investing and being able to identify the next big startup like yours, right? So the people who putting the money into the fund, they don't write a check for the whole amount. They do what is called a capital commitment. In other words, if I'm the high net worth individual and a VC fund came to me, so let's say I say, okay, I will invest $10 million. It's only a commitment. Maybe there is an advance I have to give, maybe $1 million, but that's only the commitment. And then when the VCs go identify a worthy startup and they have decided that they will invest, then they do on the people who are agreed to invest what is called a capital call. Now, I cannot change my mind at that time because I made a commitment as a high net worth individual. So the capital calls are made prorated. If, for example, I said I'll put 10 million and the fund is 100 million, my portion of that for this particular investment will be capital called. Okay. Now, so typically in this picture, you will see that a VC organization has you will keep hearing these terms if you start dealing with VCs called GPs and LPs. Okay, GPs are general partners, LPs are limited partners. It's very simple way to remember. A GP is the guy running the VC fund. Okay, LP is the guy who is putting money into the VC fund. Okay, GP is person that manages someone else's money and makes money in the process. Okay, so basically a limited partner, you will see the picture on the top. LP invests via the GP into the fund. The GP is the guy who is deciding to invest in your company, and of course your company is going to go IPO or give dividends, and those returns go to the fund, and then those returns are eventually given it to the LP. So now, how does the VC, the GP, make money? So what they do is they make money two ways, right? One is by what they call a management fee. So if me and my friend started a VC fund and we are able to convince high net worth individuals and some government organizations and being able to raise 100 million, let's say, so we typically set aside about 2.5%. It can be 2, it can be 3, sometimes it can be 4, depending on the credibility of the individuals. So if I raise $100 million, right, that's about $2.5 million. So I have $2.5 million available as a VC to set up a beautiful office in Mumbai, travel and scout around, meet people, wine and dine. So that's the money. I cannot exceed the 2.5. Okay. After that, the decision to invest is left to the GPs. Okay, so LPs don't get involved in that because they say, "Hey GP, I gave you funds because you are the expert." So GPs, talk to entrepreneurs like you, go through, lot of process which I'll go through, and then they invest, right? And when your company goes public, right? Then the money that the GP, the investor, the limited partner, sorry, LP has put in, they are paid first, most cases along with interest. After that, they split. So this is called the splitting the returns. Typically, the guy who's investing, which are the limited partners, they get the money back first. Okay, so if me and my friend raised a VC funding and invested in 10 companies, and all 10 of them did not do well at all. Okay, me and my friend end up making nothing other than the management fee, which is a waste of time. Whereas let's assume that they all did very well and there is 500 million at the end of it, right? So basically, first we pay back the limited partners. along with interest. After that, whatever is left, we pay them 80% and we keep them 20%. Now, that's a general rule. It could be 70-30, it could be 65-35. It all depends on the credibility, of what the general partners, so-called VCs, bring to the table. Now, typically, I'll tell you the success rate for VCs. This is in general true. Typically, out of 10 investments, one will be what we call a home run, okay, which is 10 times more than invested. In other words, I put $1 million in a company and I get $15 million as a return. About two of them just return the money. That is 1x. And I put 1 million, I recovered 1 million. That's not a happy state for any VC, by the way. And seven of them fail. Okay, we have to write off. So overall, the numbers work, but it's a very dicey game for VCs also. So you have to think: Are you in the seven? Are you in the two? Are you in the one? Most VCs are looking for that one home run when they talk to you. So typically, fund has a cycle. This is important, but because you need to know as an entrepreneur when are you approaching a VC, right? So typically, it's on a 10-year life cycle, and at the end of the 10 years, it's liquidated and the money is distributed. And of course, the VCs will start one more fund, and it goes on. Okay, so the harvesting, they'll get typically in 5 to 7 years. Now, but here's an important thing: if me and my friend started a VC fund, raised $100 million, I'm not going to wait until 10 years, nor am I going to invest everything in the first month. So keep that in mind. So what they do is, one more interesting thing is that if your entrepreneur, if your startup is exciting and I agree to put $1 million, I also set aside $2 to $3 million, hoping that you will need more money and I want to participate as a VC. Why is this important? Because I put money into your fund and you're doing phenomenally well. Let's say you're a Flipkart, right? And I want to have more of the action. Okay, when you do another round, and then I need to put more money. Of course, I'm putting more money at less equity because I already have some equity from you. So keep that in mind. The timing is very, very important, and understanding where a particular fund in its life cycle is also very important for you as an entrepreneur. Okay, so that's a quick, there is a lot of material available on the net, you can read up, but now you got a glimpse of how the VC fund works and what their anxieties are. They're always looking for those home runs. If they don't invest, they make no money, right? They're not doing that for management fees. Now the big question now, to VC or not to VC, should I raise, as an entrepreneur, should I raise a venture capital? Okay, here's an interesting thing: not every successful business requires a VC fund. Okay, so here are examples, bunch of examples. Now, some of them raised VC funding much after they are profitable. Okay, so remember this: you don't necessarily need VC funding to be successful, and VC funding is not be all end all. It is just a stepping stone. Okay, and there are a bunch of other sources, don't ignore that. Okay, so I know of many successful companies that made money by selling their product to a customer and getting a purchase order and not diluting this, right? You can get some grants from government. Sometimes Kickstarter example is a good example where customer is buying ahead of the product being made and they don't raise any money. They're getting to keep 100% of their company. Sometimes, banks, you can take a loan. Sometimes, of course, family, friends, and fools, what we call, you can raise some money. And in India, especially, alternate financing is also coming. There is a company called Capital Float that we started working with. They fund your purchase order. A bunch of merchants on Flipkart and Snapdeal, they have orders, but they need cash flow. And companies like Capital Float are funding. Please connect with NEN and we can put you in touch with companies like Capital Float if required. So keep this in mind when you're approaching a VC, right? They are looking for home run. They are looking for a massive, big returns. So the big question is, are you the rocket looking for a rocket fuel, or are you a kid's toy bike? They are looking at that. Okay. So the big question is, do you fit the need that the VC is looking for? It's almost like a dating game, right? And are you ready for a VC? So, and other thing that you need to think is the minute you take VC funding, you are, on the journey to become a minority shareholder. Once you go through the route, right, you are eventually, after you raise a bunch of rounds, you are not going to be a majority shareholder. When Infosys went public, I think the team, if I remember, owned 5%. Okay, but 5% is much bigger, of course. But be ready to dilute your share and not be fully in control, and be answerable to the VC the minute you decide to take VC funding. And also, of course, make sure the VC, right, it's a long-term relationship, at least a 5, 6, if not 10 years relationship, and that he or she as a VC firm can add value to you. Don't look for a VC purely for money. That's a mistake. Okay, and understand the life cycle as we talked about. Okay, and not all VCs are the same. Some VCs can drive you down the inside the ground. Some VCs can actually make or break for you and take you IPO on a Nasdaq or NSE, right? And when you come to that stage, which I'll go through quickly, do talk to the CEOs of other investments that the VC fund made to find out what kind of people are they. Are they good people? Do they add value? Are they nasty people? It's very, very important, because you as an entrepreneur, and I can relate to that, you're going to sacrifice 3, 4, 5, 6 years earning less than the market salaries on your venture. And if the VC doesn't make money, you will not make money. So it's important that you get into relationship with someone that you can work with. Okay, of course, VC funding has its benefits. They add the petrol, to your vehicle. You need that. They give you advice. Good VCs help you with advice. They make you good introductions. If you are looking for solid employees to hire, they'll help you. Remember, this it's their company too. They'll open doors. They'll open customer doors. They'll make references. Your business can go up. So good VC can help you. So there's a lot of benefits, right? However, it also comes with some downsides. So you must be aware of that, right? Example, it takes a lot of time. Oftentimes, the co-founders and the single founder end up spending a lot of their life, instead of focusing on the business, on raising the funding, right? Sometimes money also gives you false sense of security, so be aware of that. Would you spend if you didn't have the money? Those successful startups and companies spend money like they don't have money. So be aware of that. you know of course, the day you take the money from a VC, you have another boss. Remember that. This is ironical, right? I've been an entrepreneur. I've been a serial entrepreneur. We are all wired to be our own bosses. And then we take money, and then you are accountable to someone else. They are asking you for a quarterly meeting. They're asking you why you didn't achieve it. They're doing reviews for you. So can you take that? Are you okay with that? Understand that, right? And you know, and other thing is that you may be happy running the company for 20 years, but VC is not going to be happy. He needs an exit. So these are all the downsides that you need to be aware of. Okay. So to me, as I was mentioning, it's a dating game, right? It requires, to find that girl or boy, it's not easy. It requires a lot of mental toughness, right? Imagine, once to be able to find that girl or the VC firm that suits you and gives you money, you need to, on an average, you have to talk to at least 10 to 40 firms. Okay, 10 minimum, I would say. Yes, there are exceptions on the fringe where the first VC agreed to put money or nobody put the money, but this is the average. Google was turned on by 80 firms. Right? Keep that in mind. Okay, because not all VCs see the way you see it, and market conditions have to be right too. So be ready. If you once you get into the process, be ready to give it a lot of time, lot of energy, and be ready to take a lot of no's and doors shut behind you. Okay, and don't take it personally. Now, if you decide not to, if I've discouraged you from raising VC funding, if you decide not to raise funding, I still recommend that you do the VC round, because some of the feedback that you get is going to be very, very useful. All of us entrepreneurs, we need a reality check, because we're always drinking our own Kool-Aid. We think we are doing the best thing, right? So we may be, but still feedback is very, very important. So think of this as a free advice. Okay, so if you can get in front of a qualified VC and VCs, and they're giving you, oh, this won't work, that won't work, try to just take that input, listen, learn, go do your research, be ready to take the feedback, and then if you agree and your team agrees, try to incorporate that, right? So VC rounds will also help you validate your business model, validate your idea. So keep that in mind. Okay. Now, we'll get into actual process. Let's assume that now you're ready. You want to raise the VC funding. So, what are the process? Okay. So here is a simple thing of what a VCs look for. They want a big market. They don't want a niche. Okay. A big market being meaning it has to keep in mind. You take 2-3 rounds of investment, and they have to make at least 10, if not 15, 20 times. So go calculate that. Example, if you raise $1 million, right, and let's assume that you give up 30%, that means you are valuing your company today at $3 million. Okay, which means you should be able to sell the company for $30 million. If you raise two, then it's $60 million. So keep that in mind. So they're looking for big markets, okay, and the big markets that are ready for disruption, ready for doing it differently, right? And what they're looking for also is some traction, that you've identified a customer or customer segment and they are buying because you're solving a pain point, right? So they look at this is VCs, not angel investors. VCs look for traction. They don't invest in pure ideas and PowerPoints. So they want to see that your sales are growing and your adoption trend is also growing. Okay, and they also the other thing they look for is differentiation, that you have something unique, you are doing something differently, and there is enough differentiation, and you can go against the existing incumbents, and you are somehow able to defend that uniqueness. So keep that in mind. Everybody is going to ask you, how defensible is your idea, right? And you should be able to answer that. Sometimes defensibility is answered by saying, I'm going to be very fast and become a market share. Okay, example, Ola, for example. Okay, they may be the first one, and anybody else can start it, right? Of course, people have started. Their defensibility is that I'm going to go very, very fast, and I'll become a very big company, and that's why I need more money. And then of course team is very, very, very important. In fact, there is a saying that they would rather put money in the right team with a wrong idea than a right idea with a wrong team, because they believe that a right team will somehow figure it out, but a wrong idea, if they invest right with a right idea with a wrong team, right, it may not work out. So always focus. They don't normally like a one man team. I see a lot of entrepreneurs saying that I'm a one man team, I have a brilliant idea, I'll hire people. They typically look for two people, and 2 to 3 is the magic number. More than three co-founders, VCs are very, very wary about that kind of teams. So the dating process typically goes like this, right? There's introduction to the girl or the boy, and then you have a first date, and then final dating, and hopefully it'll end up with a term sheet, what is called a marriage, right? The introduction phase typically you should give it about 6 weeks. There have been cases where it takes 2-3 months, and then after that the dating process is about up to about 2-3 months, and then it can take up to 26 weeks for the final before you get a term sheet. So introduction, right? You need to be introduced, just like dating, you need to be introduced to through someone that because that has better possibility. You cannot cold call a VC and say, I have a greatest idea. They don't normally trust it. So who introduces you is very, very important in the process. So typically, other successful entrepreneurs. So this is where the mentors and angel investors can help you immensely. If, for example, a great mentor who is respected in the industry is mentoring you and he sees potential and he calls a VC and say, hey, you got to take a look at this company. They're doing something phenomenal. Then every VC will want to talk to you. Okay. Sometimes the lawyers, that set up companies can help. If you have an angel investor, if you went through the angel round, that's a great lead, because angel investors are typically make money when you go raise further rounds through VCs. So it's in their interest. If you network, so my advice is network a lot, connect with a lot of people. Number of connections that you have on LinkedIn is very, very important. And then you can request saying that, hey, I have this idea, I'm trying to connect to Sequoia or this fund, can you introduce me? Okay. And my advice is avoid the middlemen, avoid the brokers. If someone comes and says that I'll get you VC funding, I'll charge you 6%, I would avoid it. And VCs don't like them also, because they don't want their money to be going towards commissions. So be very careful about that. Okay. And then the other next tool to get that first meeting with a VC is what we call a one pager, executive summary. Okay. In one page, you should be able to describe all facets that are required to describe an idea, and that should get you interest, because no VC will ever meet you, talk to you until he or she sees that one pager, because that tells them, is it a waste of time for me? Do I want to invest in yet another Uber clone? Do I want to invest in e-commerce? So is this the space I invest in? Is this the early stage, late stage? So they make all the decisions looking at the one pager. So a very good one pager is a door opener for you. Okay. And we have templates, we can help you. Please reach out to NEN if you need any help here. And then, once they get the one pager, right? So you have shown in a nutshell, this is how they crack it open. They look at, hey, who introduced this company to me that sent me the one pager? Are they credible, right? Is this company in my geography? I don't want to invest in Kerala when I'm sitting in Delhi. Typically they, the way they look at it is, can I travel to this company in 1 to 2 hours max, maybe 3 hours if required, right? Is this a scalable business? Is the team good? You know, will I like the team? Will I like the CEO? I can quote you any number of instances where VCs just fell in love with the team, saying that, fine, we'll help you with the idea, but, I know you guys are up to something. You'll do something. So it's very important. Don't ignore the importance of the people. What I found in the VC pitches is this. Entrepreneurs just jump into the idea, the engineering, whatever. They don't spend doing that, breaking the ice. So when you go meet, remember, you are dating. Possibly this person or this group of people, right? You're going to have a relationship for 6 years. So spend time in telling who you are, right? How passionate you are, and you'll get to the idea later. But spend 5-10 minutes in making sure the VC knows who you are as a person. The goal of the first meeting is very simple. Get a second date. I see a lot of entrepreneurs making this mistake that they think someone will write a check in the first meeting. No. So don't prepare for your pitch assuming they'll write a check. All you have to do is create enough curiosity, enough interest, enough credibility in the VC's mind. So the VCs will call you for a second meeting. He'll say, yeah, why don't we see you in about a week, 2 weeks, blah, blah, blah. So that is the most important thing, right? So the way you evaluate your first meeting is, have we done enough so that they will pick up the phone and call, or have we done so phenomenally well, they already said, come back, in a month, and fixed a date. So please remember that. And the step three, if you're able to go through introduction, the first date, right, whatever, is finally the term sheet, right? Now, when you get a term sheet, and here's the irony: if you have a company or idea that is worthy of a VC funding, you are most likely to going to get multiple term sheets. You're going to get offers from multiple girls. So use that opportunity to make it a two-way. In other words, you know, I'm also looking around. I want to make sure that we are the right VC. You are the right VC for me, for our company. Give us some time. So it is a two-way street. Don't forget that. And just because VC is giving you money, that doesn't necessarily put them on a high pedestal. You are now equals. Now, these are some tips why companies fail, and this is what VCs are looking for, right? That one is lack of customers. So do not ever go to a VC funding pitch where you don't have customers. You don't need to have thousands of customers, but you have to have customers. What it tells me is that you have validated, and you've identified a type of customer that is willing to pay money or use your services. So very, very important, right? And if you're able to show some customers, either B2C, B2B, right, that goes a long way in building your credibility. And then the team, as I said, is the most important. And this is where you need to really show off your leadership. An important question that you need to answer before the VC asks you is why this idea, this startup is the right one for your team. Okay. So, because you need to show that you are bringing something to the table. For example, if you have a very disruptive, innovative idea for a new startup in healthcare, right? You have somebody in your team, like most likely, majority of them have some healthcare background or some connection with healthcare, because you have to feel the problem in order to solve the problem. Remember that, okay? And they are going to rigorously check, background check on you guys. If you say that I worked at Cisco for 8 years and that is not true, it'll come through. Okay, so make sure you put accurate information, and at some point they're going to ask you for references also, which is a good sign. Okay, the other thing they look at is that is this startup solving an important problem. In other words, is it a vitamin that is a nice to take, or is it aspirin that will cure headache? Right, keep that in mind. Okay, because just because you have a great solution doesn't mean that customers are rushing to go buy it. A lot of times, and you can relate to that yourself as a customer, inertia is very, very huge. So it may be the smartest thing that you're doing, it may be the next best thing, but customers are not going to rush it, right? So keep that in mind, right? And because customers change their habits only when they have to, right? And there are different types of customers: early adopters, right, who'll rush to new thing like an iPhone, right? And there are customers who'll want to see other people adopt it, and then they're laggards, right? So you want to identify those early adopters for your product or solution. The other thing that VCs look at is, are you just a feature, or can you build a company around it, right? Because if, a lot of times, startups, disguise a small feature, and only to find out that a big company can add. A good example, let's say, there is a fashion line or jewelry line, and it doesn't take that long for a Flipkart to just add that. And it happened, right? So that doesn't mean that online e-commerce doesn't survive for jewelry alone. But I'm just telling you that keep in mind, right? You have to ask this question and be able to answer it. Why you can build a compelling company around your startup idea, right? And if it's a product, is it part of a full product portfolio? What's the future? 5 years from now, what will the product look like? Imagine how Google started as a simple search. Today, they're more than just search, right? So look through that and be ready to answer those questions. And ultimately they're looking for a hit, right? So how can you build a huge value proposition by building a substantial business? In other words, are you just a small building block, or can you build a compelling a business out of a multiple building blocks? And the last but not least is cash flow. you know Again, I notice that a lot of entrepreneurs don't know what a cash flow is. They know what a cash is, they know what sales are, but they don't know cash flow. So I urge you, if you don't know cash flow, no problem, go read up. We can also help you, but you must thoroughly understand cash flow. You cannot believe the number of companies that went bankrupt, not because they don't have sales, but they didn't have adequate cash flows. So a CEO must thoroughly understand importance of a cash flow. Okay, so VC is definitely looking at your understanding of cash flow, and your understanding of cash flow and the planning for cash flow for this business that you're asking for money. Okay, so that kind of completes my presentation for today on raising the VC funding. I hope I've not gone too fast. I hope I've given you some good ideas. Of course, there's one more thing. following my Steve Jobs. So do remember that NEN has a lot of free resources, and we are here to support entrepreneurs like you. So, for example, we have free VC templates, so you don't need to invent. If you want a pitch deck, we have that, and you can start with that and save a lot of time. We have a one-pager template, you can download and start doing that. So don't waste time in reinventing it. We also have a great mentor network. So don't go on this journey alone. A mentor can make or break a startup idea. There is no successful startup in the world that didn't have a mentor, including Google, including Apple, you name it. So don't underestimate. Don't think that we know all the answers. It's okay to say, I need help from someone who has been there, done that. And we can help you connect with a mentor. Please contact NEN, and they will take that. And last but not least, we're starting a new program called VC Pitching Lab, where you can actually do a dress rehearsal. Of course, the slots are very limited. We do it periodically. So please get in touch with NEN and submit, and hopefully you'll make it into pitching session. We have one coming up very soon, and there are already, I think, 15 companies in queue. But selection is not by first come first served. We look at where we can help, and this is a great opportunity for you to go through the stress of getting in front of a VC without going through the stress, because we are your friends. And if your success is what we're going after, and again I need to repeat, we're a not for profit. We're not in here for commissions or money or equity. We're solely aligned towards your success, and that's what we want to do. And some of the material of this presentation came from various sources, including the MIT course, and we acknowledge and appreciate their contribution for it. And that concludes my presentation for today. Depending on the time availability, we may open for a few questions, and Ashwini will take over now.
Thank you so much, Sashi, for this wonderful session. I hope all the audience got a very clear idea on what a VC look into when they, look for good projects to fund. So let's move ahead further with our QA session. So now I request all my audience to please type your questions in the panel given below.
So we already have many questions. So it's good to see active participation. So Ashwini, let's take one by one. Okay. So can you read the first question, please?
Yes.
So one of the questions that is asked is, can I have the slides? Yes, we will post it on the website soon. And by the way, I need to remind that this webinar is being recorded and it will be reposted if you want to go through it again. Yeah. So one of the questions, Paniel, if I got the name right, Paniel Giant is asking, what are the payback options and legal issues? Okay. Now, I don't know what you mean by payback, but once a VC signs, right, an agreement term sheet with you and gives you the funds, right, you're not obliged to pay back. It's not a loan. Keep in mind, VCs are taking the risk along with you. However, the legal understanding, depending on the term sheet, is that they get to take their money first. Keep that in mind. If a VC is putting $1 million into your startup, and let's say you end up selling the company for $2 million, okay, which is not a good thing, by the way, they get their $1 million first along with interest. This is how the term sheets are written mostly, and the remaining money, right, is split based on the equity sharing. Okay, so I want to give you a tip. You see all these things that this company got acquired, that company got merged for X million dollars. That money is not going into the founders' pockets. Please remember that. People who know this sometimes smile about it. So if a company has raised $30 million and they got acquired, let's say for $40 million, it's very likely that the founders ended up getting nothing, right? So legal issues, of course, when it comes to the term sheet, you have to have a capable lawyer, and NEN is going to soon launch a entrepreneur marketplace where you can connect with a trusted lawyer. It's again, we're just connecting you with the lawyers in your locality, and you have to have a legal help in making sure you're not signing up your whole rights. Okay, so those are the legal issues that you need to watch out. The next question, there are a lot of questions, so we may not be able to take all of them. I will try to answer as many possible. So the next question is where to get the template? Whom should I ping for this meet, right? Okay, very good question. So please, email to NEN. It is available. Do you have an email ID, Ashwini? Yes. Can you tell them the email ID, please?
At the end of this session, I will be sending the email ID to all the participants.
Okay, so you can use that email, and we are revamping our website, and we will also upload that. But for now, for the email that you will get at the end of this session, please send, and someone will send you the pitch deck, which is a template, and also a one pager. Okay, and again, if you need something, please feel free to ask us, because we're also learning from you and trying to create assets that you need. Okay. Okay, I got a question. Hi, Sashi. I am Paresh Masade from wow.com. I wanted to ask you if there are any specific instructions for a B2B business. We see very less enthusiasm from the investors in B2B as compared to B2C. I agree with you that the B2C seem to be the sexiest thing today, and raising $1 billion is sexiest thing today. But B2B businesses are viewed, by VCs very favorably, because they provide, right, long term stability, in my personal view. So the diligence that a VC goes through is exactly the same, but B2C companies are very finicky, because consumers are very finicky, okay, and request deep pockets from the VCs. So actually, B2B business, if you can show that you're solving a unique problem, and businesses are making decisions, because consumer can make decisions faster, businesses make decisions slower. So if you're able to show a VC that you have signed up, you are able to sell for X number of businesses, that will go a long way. So yes, I would encourage B2B, but go pick those VCs that are focusing on your sector and in the B2B. It's very important that you do groundwork in researching about the VCs. And then another question is, hi, we're a company in the mobile app space. We're building a consumer app as well as see merit in enterprise app. However, some of the VCs we met are not keen on the enterprise piece, but we feel it is an area of opportunity. Okay, see, I can understand the sentiment of the VCs, because enterprise sale is a long sale. Enterprises don't buy in 1 week. It's a long cycle. So what they're asking is, the pros and cons. Enterprise sale is long, it will take long time to sell, but if you are able to add value to them, they continue for a long time. Okay, but very few VCs put money, in a enterprise B2E, type of a solution. And again, I don't have, here whether you are selling in India, what is your addressable market, right? Indian enterprise is a very small slice, and a lot of VCs are discouraged because Indian enterprises still don't buy, and if when they buy, software solutions and SaaS type, they buy it from US providers. So I can understand that. So you need to do more groundwork. Indian VC versus US. Okay, so one question, Logesh Kumar, you're asking Indian VC versus US. So it depending on your product and idea, right? See, it's what are you solving and where is your customer. But it's not easy to sit here and be able to pitch to a US VC. Okay, and today most US VCs have representation in India, so they are not going to, and they all have processes. So you cannot, like for example, Sequoia, for example, it's a US VC with Indian offices, so decisions is going to be made. Very unlikely that Sequoia US is going to invest bypassing the Sequoia India. True for many other things. So, without knowing what your startup is, what your idea is, my gut feeling is that you have to go through an Indian VC. So, is it mentor first or angel first? What helps more? Deepak, that's a good question. Mentor doesn't cost you any money, right? Mentor, you're not diluting equity. Mentor is your guide, your guru, your advisor. So my suggestion is definitely mentor. Of course, there are angels who can also be mentors, right? I have a personal bias towards just being able to get mentor. I personally mentor a few startups, and I make it a policy not to invest in them because it dilutes. Not it dilutes. It confuses me, right? And it confuses them also. If I am giving an advice, am I giving this advice to take care of my own money or genuinely giving it, right? So my suggestion is get a mentor first, identify a mentor, and also mentoring is a relationship. You must trust the mentor, you must be ready to be vulnerable and be honest with the mentor, what you know, what you don't know, what is working, because mentor is a very important relationship in you. And then the mentor can help you angel, with the angel funding. So yeah, to answer your question, I think I would say mentor first. Do we have to go for angel funding from a known agent angel investor before? Absolutely. I, very unlikely, who as Ashwin, that you're going to go straight to a VC. Okay. A right angel investor, is very, very important. A wrong angel investor can literally, drive you, into the ground. So, if you are looking for funding, go for an angel investor first, and he or she can groom you, take you to the milestone that makes you ready for a VC. Okay. See, please remember that these are not interchangeable. An angel investment and an angel investor has a specific role in the phase of your company, and a VC has a specific role. I'll give you this example. A VC is ready to give you rocket fuel. Okay. So if you're a bicycle or a car, you're not ready for a rocket fuel. So you're not going to close the VC funding. Whereas an angel helps you build that rocket. Remember that. Okay. Maybe give you a little bit of rocket fuel to test it. So yeah, absolutely. So Kiran is asking, in ideas like Flipkart, Ola, etc., e-commerce, where the initial 1 to 2 years would only be for advertising and campaigning. In such a case, no revenues would come until we reach a critical mass. How will company be valued until profits are positive? Okay, first of all, valuation has nothing to do with profits. Let me clarify that. If you, in fact, some VCs do not like companies that are focusing on profits. Do not like founders that are focusing on profits. Let me tell you, all these companies, Uber, Ola, Snapdeal, Flipkart, they are not profitable. Please understand that. They have huge revenues. Why they are getting huge valuations and billions of investment is because they are able to take market share, grow market share. All the VCs right now care about, or initially care about, is how fast are you growing, how fast you're becoming a key player in the market that you are doing, right? Profits can come later. What they know is that they look at what is called unit economics. Are they going to be profitable in the future once they grab the market share? All of these players are right now focusing on, even when they go IPO on Nasdaq. I heard the rumors that some of them are looking at us, IPO. Nobody cares about profits. Yes, profits should be great, but how fast they are growing. And that is the, by the way, the mentality of foreign investor, Nasdaq IPO, then a BSE, NSE. Our traditional systems are, once you are very, very profitable, give dividend paying, you go IPO in India. Not true for the new generation companies. So yeah, you have to, that's where the investment is going. Next question is, should we have a mentor from the same business segment or any other business segment? Mahendra Sharma, right? That's a very good question. One of the things that we're trying to do at NEN is to get you mentor that has, some relevant experience in what you're trying to do. Okay, so yes, now I'll put the caveat depending on where you are looking for mentoring. Example, you say I know my field very well. My father has been doing this for 50 years, but I really don't know financials and cash flow. Yeah, then you need a mentor that can help you that. Okay, but typically a mentor who can understand your business is very, very important. Hi, lots of investors are only working with tech startups. Whom should a non-tech company approach for funding? I mean, that's an excellent question. Actually, one that is my observation also as head of NEN, that everybody is paying attention to only tech startups and mostly e-commerce or mobile apps, and the genuine small businesses, SMEs or non-tech startups are not getting. There are some VCs that are focusing on it. We can probably help you identify some, but the unfortunate truth today, is the hype is about the tech startups, right? And one of our missions is actually to help non-tech startups and SMEs at NEN. Please get in touch with us and we'll see how we can help you out. So Ashwini, how are we doing on time?
Yes, we have 5 more minutes to go.
Okay, so I'll take a few more questions and then we will have to wrap up. But remember, you'll get an email. So do stay, in touch with NEN. We're here to help you. Hi, Sashi. How important is it to have customers before approaching VC? I know there is no replacement. You have to have customers. So I can almost guarantee you, if you have zero customers, which means you have not validated. Okay, no VC is going to, touch you unless you have proven. VC money comes only for scaling up, rocket fuel. Remember that, not for proving an idea. Angel money is for proving that idea. Okay, or your own personal funds. Okay, the days are gone when you have an idea, you'll create a PowerPoint, and someone will write a check for $3 million. VC money is for scaling up. Please remember that. You mentioned that cash flows are important. How are some companies are receiving huge funding without any revenues? Paresh, they have revenues. Please don't mistake. You know, any number of companies, they don't have profits. Let's not confuse, right? They may have negative cash flows, but they have huge revenues. Okay, the revenues of Flipkart, Ola, Uber, right, Snapdeal, just to show an example, are huge. Yes, there may be a few small examples, but those are not the traditional VC funding. A VC may say, these days VCs are also investing in small prototypes. They may give you a small amount of money, but that's not the traditional VC funding. Okay, they do have cash flows, but that is why, a company like Flipkart is raising money multiple times in the same year, because they have cash flows, but they are going to run out of cash if they can see 6 months. Hence they have to go raise another $1 billion in the same year. So, but yeah, they do have cash flows. Okay, so we're almost running out of time, so I'll
Last
take
question.
my last question, and that is, if VCs invest for a percentage share, do we have to buy it back at some point? No, Rahul, absolutely not. No VC will invest to be bought back. Okay, and they will not agree. Keep in mind, if your company is not doing well, you're not going to be buying back, and that's a sad state for VC. And if the company is doing phenomenally well, VC invested for the upside. He's not going to, allow you to buy back. No, if someone is offering a buyback, I would look at it very with suspicion. So no, you are not guaranteeing the VC that you will pay money or you will buy back. Okay, so erase this thought that you are obligated. He is taking the risk as much as you are taking the risk. The worst case scenario for you is you will fail and he will lose the money and you would have wasted 2 3 years of your life. But don't get into obligation where you have to buy back or pay any money to the VC. That's not how the game is played. So we have a lot more questions, but which is good. I am glad that this has created a lot of curiosity. We can't take all the questions. I hope we are able to answer as many questions. We will do such sessions more. Please look for the email ID. Please stay in touch with us. We will send you the templates to download, and thank you for your support. And count on us for any support that you need. Okay, with that we conclude this webinar. Thank you again, everybody.